VICI is down 5% year to date. It significantly lags behind the S&P 500, which is up around 16% year to date. Is it a buy now? Well, in fact, this is a stock that I have recently added to my portfolio. We're going to run through the analysis. We're going to look at the historical performance of VICI Properties. We are going to run into their income statements, look at their revenue growth year on year, as well as that bottom line net income to see how it has performed in the same direction or not as that revenue growth. We are going to look at the balance sheet. We're going to take a look at the health check, compare the total cash versus total debt. This is then going to tie into the dividend safety of the company as we look at some very important financial metrics for VICI Properties. As always, we will then run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. So as I mentioned, this is a company that I have recently added to my portfolio. Let's take a look now. So year to date, it is down 5%. It is towards the 52-week low, which is $29.29. We can see the yield over 5%, sitting at 5.19%. And for those shareholders who have held the company over the last year, your position would essentially be down 14%. So not only year to date, but also the last year, this company is down. So is this a company we should be buying that looks relatively cheap with a very nice yield that we can lock in a very high yield on cost year over year, as well as that share price appreciation? Well, let's look into the numbers. So in terms of the revenues year on year, we like to look around 5 to 10% increase for moderate growth for REITs. So total revenue December 2018, just shy of 900 million on the top line. 5 years later, 2.66 billion. So very incredible growth over the last 5 years. What we can see, there was a little dip from 2018 to 2019. However, it has been then picked up consistently in terms of their revenue, and we will take a look at their growth in percentages shortly. How does that compare to the bottom line, the net income? Well, in fact, 524 million on the bottom line in 2018, 1.1 billion into December 2022. So 5 years later, it has more than doubled, and we can see, in fact, it has gone up consistently year over year. So that's very positive to see, and a criteria that I do like to look for when looking at a company's income statement. Now, in terms of their total cash versus their total debt, to look at the health of the company, the balance sheet, well, December 2018, 578 million in cash. Latest quarterly report around 739 million. So their cash has increased. It is sitting there nicely on the balance sheet. In terms of their total debt, what do we have here? Well, 4.1 billion in December 2018. Latest quarterly report a few weeks ago, 17.45 billion. So significantly higher over the last 5 years. However, this is something that we do expect for REITs as they do acquire more properties. But let's take a look and understand the numbers behind this and how that affects the dividend safety. Straight away, dividend safety score of 50, meaning borderline safe, a market cap of 30.5 billion, making it a large cap company. Now, there is no recession data, so we can't take a look, but we can look at the other key metrics, which we will break down now throughout the next few minutes. So dividend growth, 8.3% was the latest growth in September 22, which is very good to see. I always say aim for a minimum of 4%. Dividends, salary, other income producing assets. US inflation rate was 4% over the last 40 years. Anything less, you are taking a pay cut and losing purchasing power. They have been paying dividends increasing year on year for the last 4 years, so positive to see. However, this is a slightly new dividend paying company, so do bear that in mind. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. So you could argue reasonable valuation or sliding slightly onto the undervaluation, 5.19 versus 5.03. However, we never look at any model in isolation and will draw our conclusions towards the end of the episode. Forward P to adjusted funds from operations ratio, 13.8 versus 14.8. Again, you could deter more onto the undervalued side, but also reasonable valuation as well. In terms of how it compares to the P to AFFO ratio for the sector, roughly in line at 13.5 for real estate versus 13.8. Now, I did mention it is there towards the 52-week low, but as I always say, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, if you do watch these videos regularly, you know that we don't look at the earnings payout ratio. We always look at the free cash flow, as earnings is susceptible to manipulation by management through accounting. However, for REITs, we tend to look at the adjusted funds from payout ratio. And for hotel REITs, we do look around 75% as the maximum threshold. What we can see here, for the large part, it has essentially been consistently around 70 to 80%, with 2022 at 78%, expected 2023 at 72%. So not too bad. It is consistently around there, so that is positive in my opinion. Now, adjusted funds from operations per share, 37 cents in 2017. It had a massive spike in 2018 to 143, and then from there consistently increasing, which is what I really love to see, those consistent year-on-year increases. 2023 at $2.18 expected. So again, very good to see even the forward guidance showing increases. So that's very positive. Now, in terms of the sales growth, well, what we'd like to see, 5 to 10% as I mentioned, but what we can see is incredible growth in 2017. It did then slow down in 2019 where it was relatively flat, but then again picked up to that strong double-digit growth. So this is a company that looks to be growing exponentially. How long for before it starts to flat out? That is what we need to understand. 2017, 200 million, numerically speaking, on the top line. 2022, 2.66 billion. So we can see here the incredible growth that VICI Properties has had. Now, shares outstanding. As investors, what do we love? Well, we love it when companies do share buybacks, returning excess cash to our shareholders. But typical for REITs, if you know about them and if you invest in them, they do the opposite, where they issue equity to fund property acquisitions and other projects, essentially diluting your ownership as a shareholder. Now, this is typical of REITs, so we do tend to see them increase quite largely their shares outstanding. So don't think of this as a red flag indicator, but do understand the reason behind it. And if you do want to take a look at my other videos where I look at other REITs, some do tend to do much sharper issuance of shares and some others are more flat. So it really does depend, one, on the type of business and industry, but also the relatively new and the growth of the company. As we can see with VICI Properties, they are growing quite significant and quite fast. ROIC, return on invested capital, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. Essentially, I like to look for a minimum of 10%, as it means management are able to effectively allocate their capital. However, for REITs, we typically tend to see between 3 to 6 to 7%. So I would say from 2018, fairly consistent with what we'd like to see, and in fact, a few years on the higher end. So very positive to see, and I would like for at least 2023 to be at minimum 5% and go up to around 8%, not as low as we saw in 2017. Operating margin from 2017, very good, very consistently high. We can see this is a very high operating margin business, between 63 to 95%. So as long as it can stay between these parameters, very, very positive to see as a business. Now, one thing that we did see that was a bit of a red flag indicator was the growth of that total debt on the balance sheet. What we like to see for hotel REITs is around 3.5. What does this mean? It means 3.5 years for the company to pay off all their debt, net of cash on hand. 2022, 6.46 years. However, although that is much higher than the 3.5 threshold, we can see here the next 12 months, 2023, is expected to come down to 5.66, which is positive. Does give me faith that we can see this dividend safety score go higher rather than having it at the borderline safe, but it still has some way to come down to 3.5. As always, if you are enjoying the content, value is being provided, do smash that like button, do hit that subscribe button to join the community and have these videos delivered to your doorstep daily. Now, in terms of the valuation model, we're going to run through this now to get to our intrinsic value. If you do want to grab a copy to run your own companies through, do check the pinned comment and do grab a copy. Now, Graham's valuation is one that we use as one of our 4 models. However, for REITs, they are not appropriate, so we will not include this in our intrinsic value calculator. However, for those that are new to the channel, we'll just run through the metrics and what we do. We have the stock ticker, we have the earnings per share, growth rate per analyst estimates alongside the current yield on AAA corporate bonds. This would then give us our intrinsic value. So moving on to the first model that we use for the REITs. So we have the REITs multiple valuation model. Companies in a similar sector and size. We have SBA Communications, Digital Realty Trust, and Extra Space Storage. If you do want to check Extra Space Storage, I have recently reviewed that on the channel. So we have the average P to AFO multiple of each of these entities. We have the P to AFO of VICI. So the REITs multiple valuation gives a stock price of $38.21 for VICI. As we can see there, above the 52-week high and significant room for growth, over 30% on the current trading price. We then move on to the second model, the dividend discount model. We can see the average growth around 8% over the last 4 years, which is very positive to see, above the 4% inflation. Now, moving forwards, I've gone for a lot more conservative at 4%, which is the US inflation rate over the last 40 years. A bit on the more conservative side. You could justify higher, and if you do want to play around with the growth rate, and grab a copy in the pinned comment and play around and see what DDM price you would get based on your own estimate and judgment. However, on the 4%, we'd get $40.56. Again, significant upside to the current trading price and well above the 52-week high. We then move on to the third and final, the discounted cash flow. We have the free cash flow year on year for VICI Properties. We have the average growth rate very, very high at 95%. We've come for an estimated 9%, significantly lower than analyst estimates, just to be again more on the conservative side, as I do personally prefer to be a more conservative investor. With the discount rate, we get the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt, and we get to our equity value. We then divide this by the shares outstanding to get a DCF price of $41.76. Again, significant upside to the current trading price and well above the 52-week high. As always, if you do enjoy the content, do smash that like button, do hit the subscribe, join us on the community. It helps the channel out a lot and we'd love to have you. The intrinsic value essentially comes to $40.18, showing significant upside to the current trading price and lots of room for growth. Now, in terms of margin of safety, again, strong financial metrics, wide moat, good forward-looking data, 10% would be justified, which would mean your acceptable buy price would be around $36. Now, me personally, I believe that a 20% margin of safety is sufficient for a company like VICI, which means an acceptable buy price of up to $32. Those who are looking for around 25%, your acceptable buy price would be around $30. Now, again, I'm on the more conservative side, so I've used, when applying this strategy, around 25%. So I've recently bought shares just below the $30.13 price, as $30 was essentially on my watch list. So let me know your thoughts in the comments. Now, Wall Street forecast the price over the next 12 months to hit $37.38. Again, they believe it will go higher than the 52-week high, again showing significant upside, around 25% to the current trading price. Now, personally, my strategy here with VICI Properties is to continue to accumulate shares as it goes below $30 and dollar cost average in. Let me know your thoughts in the comments. Are you a VICI Properties shareholder? Are you looking to buy or purely on the sidelines? Personally, again, as I mentioned, I will be adding as it comes down to $30 and below. Let me know your thoughts in the comments. Don't forget to like, subscribe, catch you on the next episode. Take care and have a lovely, lovely day.